Small account traders think that they have to trade credit spreads or risky leverage ETFs. But the truth is, there's plenty of stocks under 20 bucks that you can sell puts on. Welcome to episode number 2, where I'm walking through stocks under $20 that people with smaller accounts can actually use for cash secured puts. Now, I'm keeping these videos super short, quick ideas, no overthinking. First up, RIVN, R-I-V-N. They're a pretty interesting company in the EV space, and their stock has been super volatile lately. The price tends to move on production numbers, delivery updates, and anything related to EV demand. Now, I'm not trying to guess whether RIVN is going to be the next Tesla, because I'm pretty sure they're not going to be. But it's definitely a pretty solid company with a lot of volatility and a lot of people trading it. Right now, the stock last traded at $18.42. So here's an idea for you. If you were to sell a $17.50 put, that last traded for $32. So as always, we're always going to calculate our rate of return just to make sure it's a good trade. And if we divide $32 into $17.50, the capital required to make the trade, we get a rate of return of 1.8%. But that's going to be for 1 week. So if we annualize that out, it's about 95% on our money. And a $17.50 put is almost $1 less than what it's trading now. So it would have to come down a bit in order to have to buy those shares. Now let's compare RIVN against Ford. And the ticker for Ford is F. Now Ford's almost the opposite of RIVN. They're a legacy automaker with massive scale, real revenue, and a stock that trades more on the economy than hype. Now what makes Ford interesting is that it generally trades in ranges, and the options market is super liquid. Ford last traded at $13.76, and it's got much lower implied volatility, so the premium is not as high. In fact, if we sold a $13 put, that last traded at only $3, so you probably wouldn't want to do that. If we sell a $13.50 put, that last traded at $10, and if we calculate our rate of return on that contract, $10 divided by $13.50, the capital we need to make that trade, that gives us a rate of return of about 0.7%. Now, if we annualize that out, we're still making about 38% on our money. Again, it's quite a bit lower because the volatility is a bit lower. Now, just a quick reminder, selling puts doesn't mean that you're necessarily bullish on that particular stock. It just means that you'd be okay owning those shares at the strike price. If you wouldn't want to own the shares, that's not a put that you want to sell. Now, stay tuned for tomorrow's video, where I'm going to walk through 2 other tickers in a different sector, both under $20 stocks. Be sure to subscribe so you don't miss an episode. Thanks for watching.